The system does not need to watch everything you do. It only needs to make sure that anything you do can be watched. That is the distinction most people miss when they debate financial privacy. The threat is not active surveillance. The threat is latent capability. The infrastructure being built today makes total monetary visibility technically feasible tomorrow. You are not being monitored in real time. You are being made monitorable. The difference is architectural, and the architecture is moving fast. Central bank digital currencies are not a product. They are a policy instrument, programmable ledgers operating at the protocol level of money itself. The rules governing what you can spend, where, when, and on what can be encoded directly into the currency, not enforced externally after the fact, encoded in the money. What everyone believes is that this debate is about convenience, faster payments, financial inclusion, reduced friction. These are the public-facing narratives. But the structural design of programmable money reveals a different architecture entirely, one built not for the user's benefit, but for the issuer's control. To understand what is actually being built, you need to understand the incentive structure, who builds it, who benefits from it, and who absorbs its cost. Central banks do not operate on profit motives. They operate on mandate motives, price stability, employment, systemic risk containment. But mandates require instruments, and instruments require visibility. The Federal Reserve's balance sheet expanded from approximately $900 billion in 2008 to over $8 trillion by 2022, a nine-fold expansion driven by successive rounds of quantitative easing. This expansion was not hidden. It was documented in FOMC minutes, public statements, and congressional testimony. The mechanism was transparent. What was less discussed was the structural consequence. As the central bank balance sheet grew, so did the need for policy transmission mechanisms that could operate with greater precision. Consider this: when you expand the money supply dramatically and then need to manage the distributional effects, you face a fundamental problem. Blunt instruments produce blunt outcomes. Interest rate adjustments affect the entire economy simultaneously, regardless of where stimulus is needed. Programmable money solves this problem for the issuer. It allows stimulus to be targeted, conditional, and time-bounded. You can issue digital currency that expires in 90 days, forcing velocity of spending. You can restrict purchases to approved categories. You can exclude sanctioned entities at the protocol level, not at the regulatory level. At the protocol level, the distinction matters. The Cantillon effect, first articulated by economist Richard Cantillon in the 18th century, holds that those closest to the point of money creation benefit most from monetary expansion. In a CBDC framework, this becomes structurally manageable. If you control the protocol, you control who receives new currency first, under what conditions, and with what restrictions. The distributional effects of monetary policy stop being an emergent consequence and become a design parameter. Who benefits? Sovereign issuers, central banks, and regulatory bodies seeking granular policy transmission. Who absorbs the cost? Individuals who lose the structural privacy and fungibility that physical currency currently provides. The explicit financial consequence is this: programmable money transforms monetary policy from a macroeconomic instrument into a behavioral instrument. That is not a minor upgrade. That is a category change in the nature of money itself. This structural shift has historical precedent, not in technology, but in the logic of monetary control. In 1933, President Franklin D. Roosevelt issued Executive Order 61-2, requiring private citizens to surrender gold coins, gold bullion, and gold certificates to Federal Reserve banks in exchange for paper dollars. The official rationale was Depression-era hoarding and its deflationary effect on the broader economy. The structural consequence was the elimination of a monetary instrument that existed outside direct government control. Gold was not abolished. It was nationalized and repriced from $20.67 to $35 per troy ounce after the confiscation was complete. The purchasing power transfer was structural and one-directional. The mechanism in 1933 was coercive and visible. The mechanism today is architectural and subtle, but the structural logic is the same. Remove or constrain the monetary instrument that exists outside the issuer's direct control, then reissue money under conditions more favorable to the issuer's policy objectives. A second precedent, during the Bretton Woods era, established in 1944, the international monetary order was structured around dollar-gold convertibility. It held for nearly 3 decades. When President Nixon closed the gold window in August 1971, severing the dollar's link to gold entirely, it was described publicly as a temporary measure, the Nixon Shock. What it produced permanently was a monetary system where the unit of account, the medium of exchange, and the store of value were all controlled by a single issuer, with no external constraint on supply. Debt could be expanded without a fixed ceiling. Purchasing power became a managed variable, not a market outcome. The parallel to today is direct. CBDCs represent the next layer in this architectural evolution, not a departure from the post-Minus 1971 system, but its logical completion. If 1971 removed the external constraint on money supply, programmable digital currencies removed the remaining constraint on money behavior. The measurable effects of this architectural shift are already visible in observable patterns before full CBDC deployment. First, real rates. Since 2020, central banks in the United States and across the European Union have allowed real interest rates to remain deeply negative for extended periods. At its peak in mid-Minus 2022, U.S. CPI approached 9% year-on-year, while the federal funds rate sat near zero, producing a real rate of negative 8 to 9%. Holders of cash and fixed-rate instruments experienced substantial purchasing power destruction on an annualized basis. This is not an accident of policy failure. It is a predictable output of debt rollover mathematics. When sovereign debt loads are high enough, negative real rates become the mechanism by which the debt is inflated away. The cost is borne by savers. The benefit accrues to the sovereign debtor. Second, asset repricing. Persistent monetary expansion compresses risk premiums across asset classes. When the cost of capital is held artificially low, capital flows into risk assets, not because they carry higher intrinsic value. Because the alternative, holding cash or low-yield instruments, carries a guaranteed real loss. This dynamic concentrates wealth in those who already hold risk assets. Those who cannot afford exposure to volatile asset classes experience ongoing purchasing power erosion, with no compensating mechanism. Programmable money, by introducing behavioral constraints on currency use, could accelerate this dynamic further, directing capital flows not through price signals, but through protocol rules. The positioning implication for a rational actor is structural, not reactive. It is not about predicting the timing of CBDC rollout or speculating on policy trajectories. It is about recognizing that the monetary instruments which preserve optionality, assets that are self-custodied, bearer in nature, and not subject to programmatic restriction, carry structural value independent of their nominal price. The value is in their architecture, not their market quotation. The architecture of monetary surveillance is not being built in secret. It is being built in public, in policy papers, in BIS working groups, in congressional testimonies, in central bank research publications. The Atlantic Council's CBDC tracker documents over 130 countries in various stages of CBDC research or pilot programs. The Bank for International Settlements has published extensively on programmability features. The design choices are documented. The infrastructure roadmap is accessible. What is not widely understood is what these design choices mean structurally, not politically, not conspiratorially, but architecturally. Money with programmable constraints is categorically different from money without them. It is not faster or slower. It is not more or less convenient. It is a different instrument. And different instruments produce different outcomes for the individuals who hold them. The individuals who will absorb the structural costs of this transition are those who have not examined the architecture before it becomes the default. Not because they were deceived, but because the technical details are dense, the policy language is neutral, and the transition will be gradual enough that no single moment announces the change. Understanding the structure does not require outrage. It does not require opposition. It requires positioning, the calm, deliberate allocation of financial behavior and asset holdings. Positioning that reflects the monetary environment as it actually is, not as the public narrative describes it. If you understand the incentive structure behind programmable money, the historical pattern of monetary control expansion, and the measurable purchasing power effects already in motion, you stop waiting for an event that confirms the shift. you recognize that the shift is architectural, and it is already underway. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.